Welcome to a short educational video on volatility. Volatility is a very interesting and important concept for clients to understand. And with me today is Will Douglas to talk through what volatility means and what it can represent in portfolios.
Thanks, Justin. Look, volatility is naturally inherent in any traded price for any good or service. Think of the apples you might buy from Coles or Woolworths. Every time you go down there, the price of that apple is different. The value of what you get is always the same. It's just an apple, but the price of that apple is different. So those movements up and down in prices is what we refer to as volatility. When it becomes investment, when it comes to an investment, this is very important because we attach some emotion to that. If we buy something and it goes up in value, we're quite elated, we're excited. If the price goes down and we feel like we've made a loss, there are negative associations that we have with that. So an understanding of volatility is critical to understanding the way investment prices move and to help us achieve our eventual financial goals that we're looking for. So, understanding volatility allows us to cope with volatility. If we can cope with volatility and take the emotion out, we can ignore those up and down movements in traded price, and then later on, as we mature as investors, we can take advantage of that. So why does volatility occur in a traded price? Okay, we've always put forward that every investment decision contains some good, the bad, and the ugly. Think of the old Western theme. And any decision to actually purchase something would involve the balance of that argument coming out on the good side. We really think that over the time that this is going to benefit us. If we decide at a particular point in time that some of the bad and the ugly side of a nature of a particular investment, for example, you're in a mining stock and the mining boom ends. Okay, it looks like some bad and ugly side are going to come out. That may lead us to a decision to sell because we think some negative price movements are going to come through. So volatility actually helps us in our investment decisions at the same time. When we look at the share market charts that go for a few decades, what we see in the Australian example in particular is from the mid-80s to now, across about 30 years, there have been extraordinary capital gains and extraordinary dividends over that time. It's actually an 800% capital gain, and if you add up all the dividends, it's a 1300% return as we've moved through the last 30 years. It's a great investment. The problem is when we break those periods of price movements down to shorter periods, say a year or 18 months, within that last 30 years, there have been 22 falls of 10% or more. Now, to fall back by that large amount and to see growth of 1300% over 30 years, there were some very big rises too. But when people say that they feel that shares are risky and investments are risky, they're always talking to short-term negative volatile price movements. And we need to understand that this is always there. That's just the way shares move. BHP and National Australia Bank trade every day. In fact, every second of every day. And the prices move up and down every day. And there is no information towards long-term value that can be attached to those short-term price movements. They need to be ignored. Businesses only report financially twice a year. It's only twice a year that you actually get to assess whether an investment such as a share is moving its profit and its revenue towards the goals that you hope that they would be doing, creating greater future value, which is going to give you your capital growth and your greater dividend yield that you want over time. Only twice a year. So in between those periods, every movement up and down is purely just a reflection of the volumes being traded for buying. If there's more people that want to buy a particular stock, its price will go up, whether that's over 10 seconds, an hour, a week, a month, a year. If there is more volume of shares to be sold in a particular time frame, then you see share prices move down. So the key messages here are large upward and downward price movements in traded assets is a very natural part of how markets work. The second major point is share price does not equal value. If you leave the security of cash and you're looking for higher reward of capital growth and larger dividend investment over time, you leave the security of cash, you accept the long-term volatility of markets, but you need to stick with your investments in shares if you want to get those long-term rewards, and not be so concerned if in the short term you see prices move back by 10% or more. Just remember, to get the 1,300% returns over the 30-year time horizon, you have to accept 22 falls of 10% or more. And that's just the share market as an aggregate. You know, individual investments can move around a lot more. Don't worry about that. We hold your hands and we walk you through that. In the economic updates, we give you the reasons why this is happening. But one of my main service deliverables to you is education on volatility and ultimately how you can benefit from it.
Fantastic, Will. I'm just picking up on one of your points, moving away from cash and moving into the share market. A big part of that for what we do for clients would be managing their asset allocation. So what is a comfortable element for their portfolio to be invested in the share market, invested in cash, invested in property. So having a diversified portfolio can help to manage and limit that volatility. And I think that's where we work really well together for clients in setting out the expectations for volatility in the portfolio when we talk about different types of investments in different types of sectors. That's worked really well.
Absolutely. Asset allocation is the key. Diversification is the key. And even when we come down to an individual sector like the share market, we are constantly diversifying through different businesses, through different sectors. That helps protect wealth, it helps grow wealth, and it gives you a diverse source of income from healthcare businesses, energy businesses, finance businesses, technology businesses, all over time, growing that long-term wealth. You've nailed it on the head.
Absolutely. Thanks, Will. It was great to talk to you about volatility and shed some light on what can be a pretty confusing and perhaps even a stressful topic for a lot of people to talk about. And I think we've cleared the air there around what it is and how we manage it. So thanks very much, Will.
Fantastic.